Good afternoon and welcome to the fourth in our Confidentially Speaking webinar series for 2024. The topic being Thinking Fast and Slow, a webinar discussing the decision-making manner of people in negotiating and also the risk appetite, which may affect the process and outcomes in an advantageous manner or in a very disadvantageous manner. I'm very pleased to have Simon Russell, Director of Behavioural Finance Australia, with us today. Welcome, Simon.
Thanks for having me.
Simon and I actually go back many, many years to a time when we worked for a company called Liberty Financial, and we're involved in many, I would say, complex negotiations, both internally and externally to the company. And Simon went on to establish Behavioural Finance Australia, a company that specialises in working with asset managers, financial advisors, various corporations, and I'm going to get this right.
Super funds maybe would be the other one.
Yep. Super funds, in the way in which he inculcates the ideas of behavioral finance as well as other decision-making concepts to assist them in negotiation, in making decisions, and that would affect the actions and outcomes of how things work. For today's purpose, though, we focus on Simon's ability to create risk appetite tools for financial advisors, as well as the way in which he works with all those people and corporations to think through decision-making processes. Now, you might have wondered, those of you who have actually read Daniel Kahneman's Thinking Fast and Slow, why on earth are they borrowing? I won't use the word stealing, Simon. Why are they borrowing the title of Thinking Fast and Slow for this webinar? Well, quite frankly, Thinking Fast and Slow is a book on decision-making, has influenced many people, millions of people around the world, including both of us. And we use the and have been influenced by Daniel Kahneman's book on the way in which we make our decisions and also how we guide people in decision making. There's also a great book on risk appetite, as well as another book that Daniel Kahneman wrote, but I didn't think Thinking Fast and Slow and Noise kind of went together, so we didn't use the topic noise, but that's really a good book that Daniel Kahneman authored, and we'd highly recommend that you read it. But hey, finally, this is also a tribute to Daniel Kahneman, who unfortunately passed away very recently, and we hope we just don't disappoint him in the way we discuss risk appetite and decision-making. But with all that said, everything's done. I've finished all the bureaucratic admin stuff. Simon, welcome. Let's get right into it. So we always talk about risk appetite, the two of us, but many people say, well, what on earth are you talking about? Are you eating? What are you eating for a risk appetite? Can you explore it and unpack the idea of a risk appetite and what it means?
Yeah, so I guess we're thinking about it in the context of a negotiation here, because I mean, you could probably parcel it away separately for financial advice and the sort of investment decisions there. But if you think about it in the context of a negotiation, so perhaps it's worth thinking about it in sort of two components. One would be related to sort of the objective stuff. So, I mean, you could say, imagine two people who both are thinking about losing, whether they might lose $1,000. One is petrified about losing the $1,000 and the other one isn't.
Yeah.
Why is that? Well, maybe it's because one of them's actually got $1 million and losing 1,000 really doesn't matter so much. And for the other one, $1,000 is their life savings.
Yeah.
So there's an objective part of that. Just what are the facts? What's the evidence? What's the sort of all the circumstances around the case, the negotiation, the sort of the individual parties. So I guess you've got that part, which I guess I wouldn't focus on so much because I think that's sort of standard negotiation 101. You should be looking at all that sort of stuff. And then there's the psychology that comes with it as well, which is more about how people feel, their attitudes, how they interpret stuff, how they make decisions around risk. And that's where I think a lot of Daniel Kahneman's stuff, and more broadly, there's some other aspects of psychology that come into it as well, which I think we can certainly add to the objective stuff. And sometimes the psychological stuff is actually really quite substantial, and then we can perhaps dig into some of the evidence around that as well.
So let's dig into the evidence and take that example of $1,000, and let's assume both parties, I'm not going to give them $1 million because maybe $1,000 and $1 million doesn't sound that big. Anyway, For me, it doesn't sound like a huge risk when you've got $1 million if you're going to throw $1,000 in the hope of achieving something. But what about, let's say you've got $50,000. So both parties have $50,000. The meaning for them is the same. That's their savings. And then we take the $1,000. One of them says, I'm prepared to spend that $1,000 on the risk of achieving something. The other one says, oh, this is terrible. It's such a big risk. I'm not going to do it. What could be the psychological factor that unpacks this for us?
Yeah, so I'd say there's quite a few possibilities in there. So, I mean, at a very high level, you could look at the type of the individual. And so we know, for example, that when it comes to financial risks, men tend to be more willing and able, or more probably, well, let's go with the more willing part, more willing to accept financial risks.
You took a little bit of a risk there.
Right, be careful with my words. But there's definitely more risk taking when it comes to financial decision making, as a general rule. Obviously, not all men and more risk taking than all women. Of course, you can find exceptions to that, but as a general rule.
Yeah.
But then, and younger people more so than older people, and again, there's a mix of the objectivity aspects in there as well. But then you can start to dig below the surface and say, well, there's like framing effects, for example. So we've just been banding around a bunch of numbers there, and as soon as I hear a number, I'm immediately thinking of anchoring and the way that reference points will frame something as feeling like a loss or feeling like a gain. Because I mean, a fair chunk of Daniel Kahneman's book, and to be honest, what underpinned the Nobel Prize that he won was around loss aversion, and loss aversion is broadly the principle that we feel losses more than we feel equivalent sized gains. It's more than that, but that's sort of, I guess, the sort of the high level gist of it. But to be honest, to have a loss, it has to be a loss in reference to something else. Like, if I'm losing $1,000, how do I know I've lost 1,000? Well, it's because you had 1,000 yesterday. So if it's a stock, for example, you say, I just lost $1,000 on that stock. Well, I lost it because, you know what, I bought it for 2,000 and now it's only worth 1,000. So it feels like I've lost 1,000. Or maybe it could be, I bought it for 1,000. It went up to 5,000. Now it's back to 4,000. Did you lose 1,000? Well, sort of. You lost 1,000 versus the high point that it reached. Or did you actually make 3,000 because it's now above the initial purchase price? So that's it's called framing, I guess. But it's a big chunk of what sort of loss aversion and the Kahneman sort of research would suggest. But it also comes back to anchoring and the idea that as soon as you throw a number out there, that number is going to attract our attention and draw our estimates, our sense of value. I mean, I can give you a couple of examples of that if you like, because that's I mean, so outside of negotiation for a second, I can come back to where this has been applied in the context of negotiation. But outside of negotiation, this is one of the biggest sort of killer psychological effects. I mean, when I stand in front of a group, I don't want to be up there showing people stuff that I'm thinking, oh, is this going to work? Is this not going to work? I'm not sure. So I always go with something with anchoring, not always, but it's a go-to strategy because it's so strong and so ubiquitous. So you could ask someone, I think this actually in Thinking Fast and Slow, this example, what do you think the tallest tree is in the world? Do you think it's more or less than 500 meters tall? What would you say?
And you already start working around 500 meters.
Yeah,
so
that's right.
Whatever you think is tall, if you understand meters, which I don't really, but I would go, oh, maybe it's 520. I wouldn't be going, oh, it's 1,000 meters.
So what units do you furlongs or what?
I must have no concept. You could say kilometers, you could say 500 meters.
Half a kilometer. And that's going to be a very tall tree. So if I had 100 Elises in one room and I gave that question with a 500-meter tree in it, and I had 100 other Elises in another room and I gave them a question with I said 100. Do you think it's 100 meters? Imagine a tree, it's 100 meters.
Yeah.
So really, I'm asking you that question not to gauge whether you think it's more or less than 500 for the first group of Elises and more or less than 100 for the second group, because the killer question comes second when I say, oh, so how tall do you think the tallest tree is? And here, the first group of Elises who have just been anchored with this 500-meter tree idea, even though I've got no idea what meters are, well, that group of Elises might say something, oh, I don't know, maybe it's 350.
Yeah.
I forget what the tallest tree is, but
Yeah.
it's still a tall tree, versus the other group of Elises who have now got that sense of 100 in their mind. And there's no way I've said, start with 100 and start moving up. Like, none of that. The number has just been thrown out there. And that second group of Elises will come up with a substantially lower number. Oh, I don't know, maybe 180 meters, maybe. So you end up with the two groups who have come up, who've been asked the same question, how tall do you think the tallest tree is in the world? And have come up with very different answers. And that's what if you put people in a lab experiment, that's what they would do. But you can then take that all of those types of experiments, which broadly show the same type of thing, and you can put them in a negotiation context. And this is what I sometimes do with groups as well, is give them a little negotiation scenario where, well, you're buying or selling a pharmaceuticals plant or whatever.
Yeah.
And yeah, there's a lot of case sort of evidence around there. Oh, it's got this sort of equipment and it might need to be upgraded and it had that CapEx and here's a building nearby that's sold and yada, yada, yada. So you've got this sort of Harvard case study type scenario. But really it comes down to, does someone throw out an anchor in that negotiation? And if so, to what extent does it influence the negotiated outcome? And the typical anchor is the starting point. Oh, well, maybe I'll offer you 30 million for that plant, or I'll offer you 25. It's normally someone throwing the number they're willing to buy it for, or the vendor saying, here's what I'm willing to sell it for. Normally that creates the anchor. And then that significantly changes the negotiating range and the negotiated outcome.
Yeah, and that when we're talking about if we move within risk appetite, if we know the other side's risk appetite, whether they are run scared for losses or they're not prepared to project a lot to gain something, they're very conservative, I should say, have a conservative risk appetite. When we're creating our anchor, we also think through those issues as well. So we think through our own risk appetite, but we also think of theirs.
Oh, yeah, completely agree. It's going to change your own approach to it and what you feel as losses. But but I see my counterpart looking like they're conservative and not wanting to get it to suffer any losses, which is completely understandable. And I'd be fall off my chair if I found someone who had the opposite view.
Yeah.
But that is implicit in that they're suffering a loss versus something else. So I'd be going, what are you comparing? This feels like a loss to you. Why is that? What is it you're comparing with? Did you have an offer? Did someone else make an offer for this business 3 years ago? If I can understand what that is and therefore why it feels like a loss, then maybe I can start to counter it by throwing out a different anchor. Oh, you thought you were going to get 50 million for this business, but you've only actually invested 20 million in the plant. So when I'm offering you 30 compared with the 20 you've invested, that's not a loss. You've just made a $10 million profit.
Yeah.
So I can perhaps try and reframe that around the loss issue so it no longer seems like a loss and therefore I don't sort of trigger this sort of sense of loss aversion.
So what we then gather is the first thing we look at is potentially when we're preparing for negotiation, what are we looking for? But also what is our risk appetite in that, and when we even before we even sit in front of someone, say, is that risk appetite, if we thinking $1,000 is a loss, have we really framed it correctly? Are we being reasonable? Because I always say in my preparation, I don't throw out risk appetite and losses so much, but I talk about what do you really want, the kitchen sink of wants. I love the idea of a kitchen sink. If you could get anything you want, so we start with a positive, because I know people are risk averse and they try and, and it also gives me an idea as if someone's being unrealistic or realistic. If they're being realistic, we'll get a kitchen sink of wants that are infinitely gettable potentially if they with the right person. If they come up with the most ludicrous thing where you've said, I've invested $30 million in a plant, but I want $1 billion, that's not going to happen unless something wide and wacky has happened in the market. So, that kitchen sink of wants, and we start preparing them and we take that realistic test. You want this, or you said you want it, but you don't think you can get it. Or if you got it, it wouldn't be the best outcome for you. Then we test it. Why isn't it the best outcome? Why would that be a loss? Because that could be a gain. And then we come back to short-term and long-term losses. Do you want to talk about that?
Yeah, actually, I might come back as well. Can I come back to something else you mentioned there? Because you were saying, I know you were being a bit flippant when you said that you've just invested 30 million and now you want $1 billion. That's clearly ridiculous.
Yeah.
And I understand and agree with what you said there. But interestingly, when you look at the anchoring research, so in particular, I can think of a study of real estate agents where I mean, it's similar to all these other studies where the anchors made a difference. So in this case, what they said is, we want you, real estate agents, to provide an objective valuation of a property. And they give them a whole lot of information. Here's the number of square meters, the bedroom, bathroom, blah, blah, blah. You get all this information. And for some of them, they also had thrown into the pack of information the vendor's expectation for the price. And so they asked these agents, so did the vendor's expectation make any difference to you in your objective appraisal of this property value? Oh, no, of course not. You asked me for my objective valuation. I don't care what the vendor wants. I've objectively valued the property based on my expertise and comparable sales and yada, yada, yada. Now, what it showed was what that study in particular, but similar to others, showed was, well, that might be what they said, but regardless, there still were influence, so the vendor's expectation had an anchoring effect. But interestingly, so in addition to just plain anchoring, the anchors still had quite an effect, despite the fact that they were deemed to be, because they tested a range of different anchors, deemed to be unreasonably high. So outside of the range where the agent would go, well, that's clearly the vendor's smoking something, expecting that sort of number, but it still had an impact. So in your example of the 30 million and $1 billion, okay, fine, that sounds outrageous. Yeah. However, I would be cagey in saying that something was outrageous. So if your example was 30 and 60 or 30 and 100, so I might be going, yeah, it sounds outrageous, but it still might be effective as an anchor. And you don't have to throw that anchor in there as a formal offer or as a formal statement of, I'm rejecting any bid less than this ridiculously high number. Because there's quite a few examples where you could use it as an informal cue that introduces this anchor into the process and influences what people's expectations of value are, but without having to sort of tie your horse to the stake of that number, which then might lead to zero negotiation taking place because you've just done yourself out of any sort of deal.
Like when I was chased out of the out of a market stall with a vendor with a knife because I had undercut in a bargain. I had offered something that he thought was insulting. So I was saying, where you close it because you're so insulting or so off the charts that no one's talking to you. So give me an example, because that's exciting. It's saying, well, you can throw in an anchor, which doesn't actually look formally like an anchor. It's just a number almost in the wind. Give me an example how I could do that.
Yeah, so I mean, there's a few, but one of the stories that I quite like is a consultant who was, I forget the number, but I think was trying to sell a package of consulting services for something like $25,000 or something like that, and he thought it was eminently reasonable, the amount. It was comparable to other service providers, but it was having difficulty trying to sell this package of services. And he'd and he'd have to go back and sort of undercut his own number. And anyway, what he decided to do ultimately was apply some of this in principle, which was to say, I'm going to use a higher anchor to make my 25,000 sound reasonable. So he would say something along the lines of, well, judging from the amount of work required here, I'm thinking maybe in the order of 50,000 might be for this work. But given that we've been working together for a while or something, I think maybe 25. Does 25 sound reasonable? So he's never actually proposed 50,000. He's never put 50,000 on the table with the opportunity for the client to say that's unreasonable, it's too high. No, I'm looking for somebody else. However, he's thrown it into the conversation so that when he's now then said the 25 number, and this is a bit like what shops do, of course. That dress, 450. No, reduced to 250. Was it ever 450? I don't know. So there's a question about sort of manipulation and consumer protection, all that sort of stuff. But in the context of a negotiation where you don't want to put a hard number in an indicative offer that might be the last you hear from the bidding process, but you still want to influence the process. So I would say, A, you can do it informally, and B, there's often an opportunity to have anchors in various points through a negotiation. So sometimes the objection I get to people when they say, well, if you tell me it's 50,000, I know that 50,000 is ridiculous. And I know you're trying to anchor me with this thing because I've been to the local shop and I know what dresses are worth and I know what they do. Okay. fair enough. So if people are prepared for anchors, if they've got their own valuation in mind, then they've got an alternative anchor, it's probably going to be less effective. However, the headline price is just one number that you've got to negotiate. So often you'll have a whole bunch of other numbers through there. So is there a non-compete period? Is there a number of years or a maximum? Is there an amount of money that's going into an escrow account? All of these other numbers throughout your negotiation are likely to be less thought through by your counterpart. They're less likely to have alternative anchors in mind, and therefore the effectiveness of your anchor for negotiating the percentage of money that goes into an escrow account or whatever the other numbers are in that process are more likely to be effective in that process. So, yeah.
Yeah. But what I like, what you bring us back to is preparation. Because in order to be effective, you know, at anchoring, but also understanding offers that are given to us, whether we're buying or selling or what we're doing in the negotiation, if we're not fully prepared, if we haven't done our background work and looked, for example, in your case, at the markets, what is valuable and what is on offer, because yes, if it's a dress, but it's made in a certain fabric that is long lasting, one that's going to fall apart, you know, is it something that, like, you know, I'm getting a warranty, if this falls apart in 5 years, I can come in and replace it. Well, then there's a greater value to that. Is it something where I'm thinking of bringing it back to the domestic, to simple example?
I should never raise that. I'm going to be out of my depth very quickly when you start talking about fabric type. Oh.
I'm going to move it to a dishwasher. Maybe, but for example, if you buy a dishwasher and they say, well, you get free repairs for the next 10 years and you can call up the line. Well, I'm not going to mention a certain type of dishwasher or brand, but one of their greatest sales, tend to be one of the most expensive brands on the market, but it's their aftercare that is their sell. And so I guess when we bring it back to ourselves, what is it we give that actually makes us unique in a way? Why someone would want to do business with us when in preparation? What is our value and how does that value pack up? And once we've got all those items in a row, we can then anchor in different ways. So if someone says, you know, if I'm throwing that number out, well, you know, they would normally, for this kind of thing that throws in indemnities and warranties and all kinds of things like that, it's worth $50,000. But, you know, because you're such a great person, whereas if I just throw out $50,000 versus 30, someone who is quite an astute negotiator is going to go, well, don't start with that nonsense. I've seen that 100 times. So it's how you can play the unique card as to why you've thrown out the bigger number.
Yeah, I think there's a few things there. And one of the things I quite like, which, I mean, you lawyer types like to do, is say, here's our standard, I don't know, confidentiality agreement or something. Don't worry, it's just got all our standard terms in it. And I just think, yeah, okay. And do you want all our standard objections to the standard? So I understand there's the standard piece, but sort of thinking more broadly about using anchoring, I completely agree about the preparation piece. There's a real challenge if you've got uncertainty. If you don't know what the value of something is. So I don't want to go and buy some internet startup and go, I don't know, maybe it's worth $1 billion. So let me put my $500 million anchor in just to try and get it down. And meanwhile, the vendor's going, $500 million, that's an awesome deal. Sold. So I think that part of the problem. So if there's uncertainty, and the other aspect there, I think, is if there's information asymmetry, which is, it's so hard to see. If you're on the wrong side of information asymmetry, where somebody else knows something you don't, to be able to put yourself, to take the perspective of the person who knows something that you don't, and when you don't know what that thing is very difficult. So I've had teams of very smart people from sort of high-level investment banks, private equity, venture capital teams, and you give them a scenario which is relatively straightforward in the sense that as soon as they know the answer, they go, of course. However, you put them on the wrong side of information asymmetry, where they're supposed to be bidding for, in this case, it's a mining venture where they've done some exploration, they've got some results. So the vendor knows how much this thing is worth, but you as the purchaser just know they've got some results and you don't know what they are. So how much do you bid for this thing? And it looks like, from the outside looking in, when you're on the wrong side of this information asymmetry, you go, well, based on the facts, it should be worth somewhere between 0 and 100 million. So maybe I'll be conservative. I have no idea where in that range it is, so let's call it 50 million. to be conservative just in case, because there's a risk, I'm going to not offer 50 because that's a 50-50 sort of bet. So I'm going to offer 30 or even 25. Then it seems like I've got all of the weight of probabilities on my side now, because as long as this thing is worth anything more than 25, I'm a winner. This is great. Awesome. However, what people fail to effectively incorporate into their decision making there is the view that, yeah, but the vendor actually knows what this is worth.
Yeah.
So if it's worth 75, they're not going to be selling it to you for 25. They're only going to sell it to you if it happens to be worth 10 or something less than that. So you're not going to get a good deal despite the way it looks to you. So yeah, I completely agree. If you don't do your preparation and understand the sort of the landscape when you're trying to use some of this sort of stuff, it can backfire.
And that there's another person in the room. I think we forget there are two parts. Sometimes we focus too much on the other person in the room and what they're thinking, and not enough about what we need out of the deal. And then we get caught up in sometimes finding things that we didn't want in the first place, right? Or the deal just doesn't hold the appeal that we thought it should have at the time. But the other point of it is we don't always respect that the person in the room changes, and what they, as you say, they know what the deal is worth, or they might not. In my case, but we go in at our peril if we haven't prepared for who the person is, and to take time out if they come up with wild and wacky suggestions as well. So with our decision making, we've got to almost start widely and flexibly. Preparation is key, and we have to know the worth of what we're negotiating. And if not, well, if you're in a market, I'm bringing back fabrics again, you want to buy a fabric and you're prepared to pay for $100 for it if it's only worth 20. If you're happy to pay $100, who cares, right? It doesn't matter what the value is. But in more serious negotiations, we really have to have a good idea of what we're getting and why we want it, and also what the other side is and what they know. Are they tricky?
Yeah. Yeah. And in the case where that pharmaceuticals plant, where anchoring, I think it was a Harvard study, anchoring has a big impact. Clearly, it's best for you to go first in the negotiation and put your anchor out there. However, the circumstances of that are it's a plant which has got land value. It's got equipment which is resaleable. So you've got some fairly good pegs as to say, I don't know exactly what this thing is worth, but I've got some pretty good ideas that if the whole deal goes south, I could sell the land and I could repurpose the equipment and I'd get X dollars back for it.
Yeah.
So versus some of the other stuff, which is more intangible, for example, if it's more a matter of taste or there's a high growth expectation, which I think links back to the point that you made earlier, which I didn't answer, which was around the timeframes.
Yeah.
Because, yeah, your risk perceptions change a lot depending on the time frame you're looking at. And so there's a thing called hyperbolic discounting that I think Kahneman talks about, which is the idea that if I was to say, would you prefer $100 today or $100 tomorrow? Presumably you'd say I'd like $100 today.
Thank you, Simon. Yeah. Take out that.
No one carries cash now. Sorry, Elise. Okay, so fine, you prefer 100 today, but what if I offered you 110 tomorrow compared with 100 today?
Yeah.
So now the balance becomes a little bit more tricky. Oh, 110 tomorrow, but I have to come back and get my 110, and is it work? Okay, so there's a point at which people are willing to make that trade-off between today and tomorrow. Versus if you said, what if I gave you $100 a year from now? Would you prefer $100 a year from now or $110 a year and a day from now? And so normally when people are thinking, if I have to wait a whole year, what's another day?
Yeah.
That's nothing. I'm very insensitive to that difference of a day when it's pushed out a year. But the difference of a day today makes a big difference. So this is sort of the idea that we're very sensitive to these short-term losses. And losses in particular, if they're like it's the initial sort of movement from going from zero loss to some loss. That's the bit that we're most sensitive to, compared with the bit where I've already lost something and now I'm losing a bit more.
Yeah.
So what that suggests is if we're thinking about our counterpart, for example, in a negotiation, so I'm trying to get them to accept some type of thing that they view as a loss. Well, it's better to bundle up a bunch of things together and put it as one thing go, well, actually, rather than me asking you for these 10 things that all seem like losses, because you're going to have to make 10 concessions to me, and I know you don't like making concessions to me, can I in some way bundle them together? So it just sort of seems like, oh, that's actually one thing you're giving me now. Yeah, it's a bit of a bigger thing, but psychologically it's going to feel less impactful than me asking for 10 things.
Yeah.
And the reverse is, if I'm making concessions, I want to make them feel to my counterpart like they're significant. So rather than me going and giving one big thing, can I break it up into 10 little things?
Yeah.
And so that means that maybe there are 10 bullet points on an email, maybe there are 10 items on the term sheet. Maybe I've broken them up so that I give them progressively over a series of meetings so that it seems more impactful. But again, it goes back to sort of Kahneman's view of how we're impacted by losses and the sensitivities, particularly around the initial losses versus sort of longer term losses or sort of progressively larger losses.
Which then takes us to decision making when we're thinking of preparing our strategies, both for us and the other side, in the fact of saying, well, what does this mean to us for the short term versus the long term? So it might actually be, who knows, not a loss. It might be, it sounds great. I'm going to get $100 today, right? And I'm going to give something up because I'm getting my $100 today. Yay, right? I don't have to come back tomorrow. It's in my hand. Simon's taking his wallet out. It's just great. I walk out of here with that money. But then I think to myself, well, would that be like in a year's time? What does that $100 mean to me in a year's time? What does it mean in 3 years' time, 5 years' time? Whereas if you say to me, well, I'll give you $100 for the next 10 years, every year on a certain day, I'd have to check whether you were good for it. But, it suddenly becomes, oh, well, actually, you can either take the $100 now, or over time you can earn $1,000, right? Suddenly, well, is that $100 so exciting for me? Do I really need that? Maybe the longer term thing. And I use it more for comfort and in business, like, business relationships. I can get the debt paid today and I can get the money and my cash flow is great. Alternatively, I'm going to lose this client forever. And I know they're good for it. They're just going through a bad time. So maybe we can agree a payment plan for them, but also that they keep working with us and we work out a way in which they can work. And then I keep that relationship, I keep working and the networking happening and no bad vibes, as they say. We keep relationships going. So that long-term consideration is very important and short-term, and understanding in ourselves we actually do succumb to the short-term loss versus the longer term.
Yeah, and what I like in particular about that scenario is that you've got the components of the sort of the objective reality in it. So in your example, you had, I might lose this customer, maybe they're going through hard times, maybe they're cash flow sensitive right now, which is objectively related to their circumstances. Yes, there's some reason why they're very sensitive to cash flow in the short term. But then there's also a subjective or psychological component to it, which is that people tend to be, regardless of whether they actually need the money in the short term, more sensitive to short-term gains and losses than they are to the longer-term ones. So I completely agree with you that the idea of trying to reframe your own thinking to say, what does this look like in a week? What does it look like in a month? What does it look like in a year? What does it look like in 10 years? And your preferences and priorities will change, I would imagine, in many cases, quite substantially over those periods of time. And the same sort of thing, because I think going to longer terms is sort of, tends to be a broader type of perspective. But look at what Kahneman would call broad framing, which is to say, whenever we're negotiating something, we could be negotiating a particular term of a contract, and we might focus on that term. And of course, you do want to focus on that term. However, we can also take a broader frame, which is say, what does that term look like in the context of all the other terms of the relationship of the entire business? And that broader framing is at least as good as just the narrow framing, but because it captures other things, it can substantially change your position. So, I mean, some things are obvious, like, I don't know, a hedging contract, for example. Gosh, I don't want to take on that hedging contract because I might lose money if the currency goes the wrong way. Well, the reason we've got that hedging contract is because we've also sold a whole lot of stuff in US dollars, and actually those two things will offset. So that's an obvious one because it's set up for that purpose. But that's broadly the principle he's making, is that we should be taking a broader as well as focusing on the narrow, which of course we don't want to just overlook the specifics, but we do need to take a broader perspective as well.
Yeah, and what is the risk for us? I love thinking broadly. So what is the risk of someone like me focusing too broadly and saying, well, look, we've got all these relationship and this is fantastic, and not spending enough time on the narrow?
Well, I think what Kahneman would say is that we need to focus on both. However, as a broad generalization, people tend to focus too much on the narrow and not enough on the broad. And so one example of that is what he would call the inside view and the outside view. So the inside view would be, say I'm a business owner and I'm selling my business. So my inside view is I know everything about my business. I know nuts and bolts. I know exactly the customers. I know everything about my business. My view of the world is framed around me understanding my business, versus someone coming to buy that business who doesn't know all that information, who's going to take this quote unquote outside view. And the outside view is going to be saying, well, I don't know about your widget manufacturing business, but I know widget manufacturing generally. And this is how it works generally. They're mostly valued like this. They mostly have this sort of problem. They mostly have this sort of financial arrangements, whatever it is. And so I think what Kahneman would say is we need to blend the inside and the outside views. And the more you know about the inside view and the more certainty there is around the inside view, the more you should weigh it towards that end. But when you've got uncertainty, we should stop looking so much at the inside view, because it doesn't really, if there's uncertainty about that thing, we should then look at the category and say, well, how does it normally work? And he gives an example, I'm pretty sure that was in Thinking Fast and Slow, where he's saying he knows all this stuff, and yet despite that, I think he was in a committee that was intended to write a textbook or something. And he gives a scenario where they formed a committee where they were going to have to write the textbook, and they made an estimate of how long it was going to take. And I don't forget what they said, 12 months or some, I don't know, 18 months maybe at the outside, something like that. I forget. I haven't seen the example for a while. And then he said to someone who'd done this sort of textbook work before, he said, oh, how long does it normally take you? Oh, 6 years. And I think at the end of the book, he writes, and 6 years later, we were still working. Yeah.
Yeah. So that's exactly. Oh, I'm very excited, Simon. Someone's asked us a question. Actually, you a question, which is a good thing. Does Simon think people invest sufficient time in negotiation preparation relative to actual negotiation, or do people mix the two up?
Well, I guess my focus is on some of the sort of psychological issues and say, do people spend enough time thinking about these things? So anchoring, for example, which as I've said, it would be near the top, if not the very top of my list. Do people spend enough time thinking about that one to say, what are the anchors in my mind as I'm approaching this negotiation? And what are the anchors that might be in my counterpart's mind? And what things should I think about introducing as a potential anchor? Do they think about that sort of stuff? And no, they do not, because I give them exercises. I don't sit with them when they're negotiating transactions, because they tend to not trust me to do that, but or for other reasons, I don't know. But when I give them exercises, that is far from what they're thinking, which is not to say they haven't prepared for the negotiation, because they have thought through those more objective things. They've thought through, yes, what were the comparable transactions? What are those valuation multiples? Et cetera, et cetera. They've got their checklist, they've done their due diligence, but have they thought about the anchoring? Have they done perspective thinking, perspective taking? Have they thought about information asymmetries? All of those sorts of things. That's where I think the low-hanging fruit, I guess, I've got a lens that looks specifically at that, and what do they say? If you've got a hammer, everything looks like a nail. But I see a lot of nails. Which is that's why I've sort of got a bit of a checklist that says, and here are some of those sort of psychological things that are very easy to overlook, don't take that much time to think about, but can be quite powerful. So I would give a mixed answer to that. That's they don't think of enough, prepare enough about some things, but possibly spend enough time on others. I don't know. What's your view?
So my view, is that I always, from my experience, is that most time people don't prepare enough for negotiations. But there's both. It's the pre-prep. It's the pre-prep, as in doing all the background information, looking at your anchors, understanding who you are, what you want, and what it means to you. Not just the market, but what it means to you. But then I also consider preparing for what might happen in the negotiation room. because I think there's you can come with all your anchors. You can work out exactly what the market's doing, and suddenly someone drops a bomb in the, something you hadn't planned for, you hadn't thought of. How do you move away from that? And that's the psychology behind that. You can prepare a certain way, but psychologically, if things are completely not what I'd prepared for, how do I deal with that? And part of preparation is getting your mind right to accept that. And so that's part of what I bring is how do I make you as flexible as possible? Do your anchoring, do all of that. As far as the negotiation room as well, you can do preparation in the negotiation room. If something's happened that you weren't expecting, even if you're sitting in the room, you can stop. And unless there's a bullet to your head, you can stop and you can walk out and do all your prep again. Reevaluate your anchors, reevaluate your framing, because you've learned something that you didn't know before. So I always say it's part of a kind of synchronous process that comes and goes. You never lose the preparation within the negotiation. Um, I give an example, a very simple example. I was mediating something to do with a lease, and a tenant had left the property in disarray, and the landlord was claiming damages, and the landlord came with all the documents to prove the damages, the photographs and everything. And I went to speak to the tenant and I said, yeah, what's your perspective? What's your position? He said, oh, I know I owe the money to fix up the premises, but I just want him to thank me for putting in an air conditioner. He's never done that. Is that really all it is? Yeah, he's never thanked me for that air conditioner. So there, was the landlord with all his documents. So I ran back and said, did you remember that air conditioner he put in? Yes. Would you thank him? Yes, absolutely. 2 seconds later, we had agreed something. Everything was resolved. So, we've got to prepare for that. And you've got to be able to be flexible. The way you prepare and what you do, it's synchronous and adapt. So your framing keeps moving, your anchoring might move, but don't just rush into it just because something's changed and you're someone like me who goes, oh, that sounds really interesting. Let's just dive down that path. Bring back the prep, remember the prep, and do what you do with the anchoring and the framing again.
Yeah, I think I'd add a couple more things there. I think one possibly is that I suspect our clients might be a little bit different.
Yeah.
So if I'm talking about private equity venture capital guys, and they're doing these negotiations all the time. So they've got like, I don't know, they've got sort of a track record, a history. They've got processes around this sort of stuff. So they've sort of well geared, I think, when a term sheet or a business proposition comes across their desk, that they've sort of put the gears into motion. Versus the vendors who might be, this is the first time they've ever done it, or small business owners. When I used to help financial advisors sell their businesses or merge with accountants and that sort of stuff, and they might do it once in a lifetime, and so it's all very new for them. But even in the private equity venture capital space, one of the things that I think would be useful, that I've seen advocated elsewhere in sort of academic research, and I've seen used well in things like sales teams, is role playing. In sales teams, we used to do it all the time. You go, all right, we're going to role play. You be the customer. You be a quite aggressive customer, or a customer who's not particularly interested or whatever, and let's have a few conversations to see what happens. And even though that isn't a real customer, but you see stuff coming out of that conversation. Go, oh, yeah, what are you going to say about that? But I don't see people taking that role play into a professional environment where it's again a private equity venture capital team who are actually sitting down with one of their colleagues going, right, you be Joe Bloggs selling the business, all right, and I'm going to have this conversation with you and let's just see how it goes. So when I ask them about that, they say, oh yeah, we've done our preparation and we've thought about that conversation. And I'm sure they have to some extent, but those role plays, there's stuff comes out of those which you wouldn't have necessarily anticipated just on the spur of the moment or something out of left field. And so I think they're quite valuable and underutilized as part of the preparation process.
So basically what we're saying is we have to psychologically work with venture capitalists and those who negotiate often to say, well, although you think you know it all, maybe just try this once and see as part of our preparation. Because I think I know myself, two of us have been negotiating for years. anchoring, framing, we kind of know it. And then you found yourself in a negotiation and it's like, oh, I haven't seen this before. Wow, that guy was really good. Well, the way they did it, the way they turned it around. We're always learning. And I think that's part of it, is to say, you might have done this 500 times before, but someone who's been perhaps role playing and playing things might come at a completely different, because you stay the same. It's like the insurance companies that negotiate settlements during mediation. They're the same people. They come in, they follow the same track record. And then if someone comes in from left field, they don't know what to do, or they kind of don't get the best outcome because we so know what we're doing. We've done it 500 times before. And what does Simon suggest for setting aside an anchor that the other side has put in the negotiation discussion?
So if they've used an anchor on us, very, very tough, this one. So for a start, it's good to be able to identify it as an anchor, but that is clearly not enough. So I've had groups, for example, where I've given them a little exercise, I've thrown an anchor out there, and I had a room of about 40 people, and I gave them the exercise. I had to judge how many M&Ms were in a jar, and I gave them a piece of paper which had an anchor on it, and I said to them, this is interesting. So half of the tables had a high anchor, half of them had a low anchor, and I was going to add up the numbers and sort of see whether the anchor made any difference. But before I did, so they're in a behavioural finance sort of psychology session. So they're going to be aware that I'm going to try and play some tricks on them. So as I've collected up the piece of paper with their answers on it, and I said, just before we put these on the board, let's just have a look. How many people were aware that I've used anchoring on you by throwing this number out here and giving them a suggestion as to whether the number in the jar was high or low? Every single hand in the room went up. Oh, yes. We know what you're doing here, Simon. You've thrown an anchor at us, but don't worry, we're on to you.
Yeah.
And at the time, I was a little bit nervous. I thought, I'm standing in this room, and they all know what I was doing. And so will the people who have got the high anchor adjust down for it? And will the people who've got the low anchor adjust up for it? And will I just put all these numbers on the board and they'll all show the same thing? The anchor hasn't worked. Anyway, I did not need to be nervous at all, because the anchor worked perfectly well. People with the high anchors gave me a much higher number. Not even close. It's like 70% higher or something. So the fact that you're aware of an anchor, I think, is a good start, but it's clearly not sufficient. So what can you do about it? A couple of things. One is to say, can you use an alternative anchor? So fight fire with fire, effectively. Anchors are very hard to get away from. So can you use an alternative? They've just said they're willing to only offer me $20 million. Let me not focus on their 20 million they've just said, because I know I'm going to be affected by that. But let me go back to the $40 million, which was my kitchen sink or whatever that you've called it at the start, which is to say, I have thought about my number, and my number is going to help anchor me so that when I go back, and that there's some good research around that, which is around, it's just prompting people to think about those alternative anchors. So it's not like the $40 million is news to them, for example, but it's prompting them to think about it at the point where they're going to be making a decision, so that the 20 isn't sort of focusing their attention. It's go, yep, they've just said 20 million, focus back on the 40. All right, now maybe I'll go back to 35, but I'm not going from 20 to 25. I'm going from 40 to 35. I've sort of re-anchored myself. So that would be one strategy, which there is some evidence around. And that's like a checklist, by the way. That's just making sure I've thought about it at the right time. And the second thing I would say is, because it's so difficult, that once people have anchored, if like in your example before with the $30 million property or business or whatever that someone wanted $1 billion for, if they're genuinely anchored by $1 billion, it's so hard to overcome that anchor in them. I mean, I can, till the cows come home, tell them about 30 million and they still might not listen to me. So my other suggestion there, I guess, is if it's a strong anchoring effect and you can't overcome it in that way, maybe it's safer to walk away from that rather than battle and then end up with something that you're not happy with.
I think that's the core, isn't it? It's like, there's no point in negotiating something that doesn't work for you. And sometimes in the cut and thrust of the negotiation room, and what we taught, there's a theory, there's the anchors, you get caught in the sweep. And your idea of, we keep our checklist, we don't lose what is important to us, we don't lose our anchor. And I mean, ways of getting around that is to say, well, thank you for that, and either say, I'm taking a break, or start not even discussing the number. You mentioned 20. I'm not going to counter you at this stage. Just say, look, that number's unacceptable. Let's just talk. And I'm going to throw out academic terms, interests, my interests here. And, I'm looking for this, and that. That number doesn't sound like it even would encompass that. That value doesn't work. So let's talk about what I'm looking for, this, and this is what I'm giving you, et cetera, et cetera. And having looked at the market, we're coming to 40 million. And so you've actually just disregarded the number completely and brought it back to something that is not numeral. It's actually value.
Yeah, but you want to put a number next to that value, though. I think
you do, but you build to it. So what I mean is you don't just go, well, 20 million, 40, I'm going 40
I'm not going to double it. No,
it's just like, I'm going to leave it there because that's unacceptable. So let's talk other things at this point and we'll get back to numbers. And then you start building your value and slowly and start adding the numbers in. In the market, if I got this, it would be worth this. And so really for 50 million, because I wanted 50, really 50 million would be a really good start because of all these numbers. Now you've re-anchored it, but by that time the 20 million has flown down the river because you've moved on for a while. And I think that's the practical way of doing it, but it is important. You don't have to get stuck on an anchor, and walking away is a very strong it's a very strong action. The problem is you've got to be ready to walk away.
Oh yeah, you've got to have an alternative to that. That's worthwhile.
Yeah.
One other quick bit of research that I would add to that, because I would agree, you want to obviously back up what you're saying with some evidence, but the anchoring is so strong that, I mean, there are studies, and one that comes to mind is of German judges where it was a scenario where someone's been caught shoplifting and they're thinking about the jail term in a number of months. And they would say to the judge, okay, Jack, just before you tell us what you think the verdict should be, because this is a mock trial, it's not an actual trial, let me just roll these two dice. Oh, look, a 6 and a 3 makes 9. Okay, how many months do you think? Oh, 8. Oh, really? Or the dice would be loaded to come up with a 1 and 2 makes 3. Oh, only 4 months then. Oh, really? Okay. Is that based on of course it's not based on the dice. It's not based on the dice. The dice have got nothing to do with it. I just saw you roll this. What are you doing with those dice to play? So this sort of goes back to the real estate example as well, that even things that look like they shouldn't make an impact, even there's a good chance that they do make an impact when it's anchoring. It's just so strong, those numbers become embedded in what you're thinking. But I agree, you don't want to be going, gosh, the temperature today, 22 degrees? Oh, I'll offer you 21. No, clearly you don't want to look stupid. You're going to undermine trust and there's going to be other implications. So in a practical sense, I agree. You want to back it up with some substance. But we shouldn't overlook the power of an anchor, even if it's of no actual logical consequence.
No, it works. Like, we know it works because people keep using them, right? And I remember someone saying, "Well, I never go first," and I thought, "Oh, why?" Because I want to see what they want, and because they didn't realize the strength of the anchor. But on the other hand, we've got to be aware that when someone goes first with the anchor, we don't have to be better to it. We can use it if it's within our realm, and we can use it to walk around. But if it isn't, and it's not where we're heading, we've got to learn to be able to discard it.
Well, yeah, but also think about how much uncertainty there is. So if someone comes to me with a number and I know what the real value is, then it's easier for me to go, you've offered me 20, but I actually just bought this for 30 yesterday. I know, versus where there's more uncertainty, or maybe where they know something else that I don't, and then it becomes a bit harder, I think, as well. So again, it depends on the context.
And our risk appetite, coming back to that. So let's flow that in with the risk appetite. We've gone through, I'm just saying, if anybody has any questions, we're almost coming to the end of the webinar, so please feel free to ask more questions. But let's roll that back. We talked about risk appetite, we talked about decision making, we've thrown in anchoring with all that. How do we, if I'm sitting there going, psychologically, I've got to think of what the loss is worth to me. I've got to try and anchor something. I've got to frame it. Like, how would you, succinctly, and I know this is like a very difficult way to do it, but how do you try and get a simple explanation of how they manage their risk appetite, their anchoring and everything, in a way that can be effective, because it can be quite overwhelming?
So I would be asking, I guess, what is the scenario that we're talking about where this is relevant? So and then apply the tools to that scenario. So if the scenario, for example, was, well, I'm looking to buy a business, but I'm really concerned they've already manufactured some dodgy products, and I don't want all the previous customers to come back with warranty claims, for example. And the logical obvious answer to that would be, well, I'm going to give the warranty claims back to the vendor for some period until I can get. Okay, so there's a logical aspect to that. But if that's what the manifestation of risk is at this point, I might be then going, all right, so then how do I apply some of these tools to help me negotiate that term that's going to help mitigate that risk for me?
Right.
So that might be, I don't know, splitting the warranty terms into sort of 2 or 3 categories if it helps to. Well, actually, sorry, if I want them to make a concession, I want to aggregate them into one category. So it'll be less psychologically painful for them to concede that to me, for example, or throw an anchor in about the term, for example. Well, we could ask for 3 years worth of warranty claims to be covered, but I think actually only 2 years would be fine. So that it's that sort of thing. It's to say, what is the outcome I'm after? What am I trying to negotiate? And therefore, how can I apply these tools to that scenario to help me think through it and to help influence the person I'm negotiating with to get to hopefully what is a win-win situation? Because I mean, in that sort of situation, from an objective perspective, you'd say, well, the vendor should be in the best position to understand and to manage the risk of previous warranty claims, for example. So objectively, it should work. And psychologically, we just want to make sure that the pieces fit so that my risk appetite for these short-term losses that I can't control or understand properly is sort of, well, it's going to be more significant probably than their psychological feeling of these are losses that they understand, control, are familiar with, for example. So it's just, I guess it's bringing the psychology and the objectivity pieces together to make them complement and to get the answer that suits both you and your counterpart.
I know that was quite a complex question and very succinctly put, Simon, as you always do. And so basically what we learn from this is that negotiations aren't a formula. We can talk about anchoring, we can talk about risk appetite, we can talk about formulas, and we can do all the research, but our own psychologies and each individual psychology affects how we behave on a day, our decision-making process, whether we're prepared to accept risk, and we might even change our risk appetite depending on the day or the month or the year, whether it's sunny outside or very
Yeah,
gloomy
that's
in
right. Whether you
Melbourne.
just had a nice lunch.
Yeah, we haven't though, have we?
No, that's right.
Confidentially speaking, has messed up. We didn't feed Simon before this.
That's why I'm so grumpy.
So that's why he's grumpy, and I'm not going to negotiate yet with him until we've fed him. So thank you so much, Simon, for coming and imparting your wisdom, which I always find very impressive and has influenced the way I negotiate and think. Where can people find you and Behavioural Finance Australia?
Probably best place to find me is via LinkedIn. Just look up Simon Russell, Behavioural Finance, something like that. I'm sure it'll pop up.
Great. And thank you once again for coming to our Confidentially Speaking webinar. If you have any questions, you go home and you think, oh, I really would like to take this a bit further, please feel free to send us messages on LinkedIn and keep in contact and see how we can help you. If you're looking for Confidentially Speaking for mediation, negotiation coaching, or assistance with your negotiations, but not financial behavioral, please find us on www.confidentiallyspeaking.com.au or follow us on LinkedIn. Thanks so much and have a lovely afternoon.